March 2026. A summit announcement no Western media covers seriously. BRICS nations unveil a commodity-backed settlement unit for cross-border trade. Not a dollar killer, not a reserve currency, just an alternative clearing mechanism for energy, metals, and agricultural goods between member states. While you're watching this, shipping containers are being priced in yuan. Bloomberg terminals are processing bilateral settlements that bypass New York entirely. Treasury desks are seeing softness they can't fully explain. Most analysts call it symbolic, a political stunt with no real teeth. But here's what they're missing. The real threat isn't a dollar crash. It's the dollar being quietly bypassed in the plumbing of global trade. And that shows up first, not in headlines, but in 3 invisible pressure points. Treasury auctions, import pricing, and domestic inflation you can't explain away. By the end of this video, you'll understand 5 pressure points that activate when a parallel settlement system launches. You'll see why history shows the transition happens through constraints, not drama. You'll learn which signals reveal the bypass is already working. And you'll understand why your purchasing power erodes before the system officially breaks. This isn't about predicting the future. This is about recognizing a pattern that's played out 3 times in the last century. The same sequence, the same pressure points, the same outcome for those who hold the declining anchor currency. When a parallel settlement system emerges, 5 pressure points activate in sequence. Not all at once. Gradually, then suddenly. Pressure. Point 1. Reduced dollar necessity. Trade that previously required dollar conversion now settles directly. Energy exporters accept alternative units. The dollar remains dominant, but less essential at the margins. Here's how it manifests. A Chinese manufacturer buying Brazilian iron ore no longer converts yuan to dollars to reals. The transaction clears through Shanghai, not New York. Each one represents demand for dollars that simply vanishes. Pressure point 2, Treasury auction softness. Foreign buyers hold fewer dollar reserves, so they need fewer treasuries. Auctions show subtle stress. Bid-to-cover ratios tick down, tails widen. The Fed compensates by buying more, but that's just monetization with extra steps. When a sovereign wealth fund reduces its treasury holdings from $200 billion to $180 billion, that's $20 billion in demand that must be replaced. Someone has to buy that debt. Usually the Fed does. Pressure point 3, import cost pass-through. As foreign holders reduce dollar balances, the currency loses value relative to goods. Import prices rise faster than domestic wages. Official inflation numbers climb, but your grocery bill climbs faster. This is the stage where the average person starts feeling something is wrong, even if they can't identify the mechanism. Pressure. Point 4. Capital flight rotation. Wealth moves from dollar-denominated paper into real assets. Commodities, foreign property, businesses with pricing power. The movement is legal, quiet, and accelerating. Family offices shift allocations. Pension funds rebalance. Sovereign wealth funds diversify. None of it makes headlines, but all of it shows up in asset prices. Pressure point 5. Policy constraints. The government faces an impossible choice. Defend the currency with rate hikes, which crashes the debt-fueled economy, or print to cover obligations, which accelerates the debasement. Either path leads to the same destination. This is where the trap closes completely. Today, we're somewhere between pressure point 2 and 3. The cracks are visible to those watching the plumbing, still deniable by those watching headlines. This pattern has precedent, not speculation. Documented transitions where the anchor currency lost its exclusive privilege through bypass, not battle. August 1971. Bretton Woods collapses. The story you know, Nixon closes the gold window, ends convertibility, the dollar becomes pure fiat. But here's what actually triggered it. Foreign central banks, especially France under Charles de Gaulle, were converting dollars to gold faster than U.S. reserves could sustain, not because they wanted to destroy America, because the math didn't work. The U.S. was printing more dollars than it had gold to back them. De Gaulle's finance minister explicitly stated the strategy. Exchange paper dollars for physical gold while the exchange rate still held. France alone converted $750 million in a single year. Other nations followed. Germany, Switzerland, the Netherlands, all quietly draining Fort Knox through official channels. By August 1971, U.S. gold reserves had fallen from 20,000 tons in 1950 to under 8,200 tons. Nixon didn't choose to end convertibility. He was forced to, because continuing the system would have emptied the vault within months. The privilege ended through constraint. Foreign holders recognized the mathematics before the public did. They acted quietly, systematically, and by the time Nixon made the announcement, the decision had already been forced by capital flows, not policy preference. January 1999, the euro launches. 11 European nations create a parallel currency system. Most American analysts dismissed it as unworkable. Too many countries, too many competing interests, no way it survives a crisis. But it wasn't designed to replace the dollar. It was designed to reduce European dependence on dollar clearing for regional trade, and it worked. Germany and France could now trade without touching New York. A BMW factory in Munich selling cars to a Renault dealership in Paris settled in euros. That transaction previously required dollar conversion. Not anymore. By 2003, the euro accounted for 25% of global foreign exchange reserves. Not by conquering the dollar, but by offering an alternative that met specific regional needs. The dollar remained dominant globally, but its exclusive grip on European trade was broken. Permanently. The transition was peaceful. No war, no crisis. Just a parallel system that proved viable, attracted users, and reduced necessity. 1931, 1936. The gold standard exits. Britain leaves in 1931. The United States follows in 1933 with domestic gold confiscation. Other nations exit throughout the decade. Not because gold was obsolete, but because maintaining the peg became mathematically impossible during deflation and debt crisis. Britain faced 20% unemployment and couldn't devalue while tied to gold. The political pressure became unbearable. When Britain exited in September 1931, the pound dropped 25% within weeks. Immediately, their exports became more competitive. Unemployment began to fall. Other nations watched and learned. The U.S. followed in 1933. FDR made domestic gold ownership illegal, forcing citizens to sell gold to the government at $20.67 per ounce. Then he immediately revalued gold to $35 per ounce, a 69% devaluation overnight. Who benefited? Those who held real assets, land, commodities, productive businesses. Who got crushed? The middle class, holding currency and bonds. Savings accounts lost 40% of purchasing power in months. Governments faced a choice: defend the gold parity and accept economic collapse, or devalue the currency and break the promise. Every nation chose devaluation. Every citizen holding currency-denominated savings paid the price through reduced purchasing power. The pattern was identical across nations: constraint, then policy response, then wealth transfer. The lesson from all three: privilege ends when the mathematics become unsustainable. The public learns about it through announcements. The insiders act on it through capital flows months or years earlier. So what are the signals that pressure point 2 and 3 are already activating? Start with the dollar's share of global reserves. In 2000, the dollar represented 71% of allocated foreign exchange reserves. Today, it's 59%. That's a 12 percentage point decline over 2 decades. Not a collapse, but a steady, documented erosion. Where did that 12% go? Into euros, yen, yuan, and increasingly, gold. This is central banks explicitly choosing to reduce dollar concentration. Not because they hate America, but because concentration is risk. Now watch energy trade settlements. Russia and India now conduct significant energy trade in rupees and rubles, not dollars. The mechanism: India pays Russia in rupees. Russia uses those rupees to buy Indian goods or holds them in Indian banks. No dollars required. The transaction volume exceeded $40 billion in 2025 alone. China and Saudi Arabia signed agreements for yuan-denominated oil transactions. Saudi Aramco now accepts payment in yuan for crude sold to Chinese refiners. Those yuan get deposited in Shanghai, not recycled through New York. The volume is still small relative to total Saudi exports, but the precedent is set. The infrastructure works. The UAE settled LNG exports to China in yuan through Shanghai Petroleum and Natural Gas Exchange. These aren't theoretical. These are documented transactions, moving billions of dollars worth of energy outside the dollar system. Each one represents demand for dollars that no longer exists. Here's the part nobody's connecting. When a country doesn't need to acquire dollars to buy energy, it doesn't need to hold as many treasuries in reserve. That flows directly into pressure point 2. Watch Treasury auctions. The 10-year note auction in January 2026 showed a bid-to-cover ratio of 2.31, down from 2.47 the previous month. That means for every dollar of bonds offered, there were $2.31 of bids. Lower ratios mean weaker demand. Foreign participation in Treasury purchases has declined from 30% to 24% over the past 18 months. That's a 6 percentage point drop. Who's filling the gap? The Federal Reserve. The Fed's balance sheet has expanded to compensate, which means the central bank is monetizing debt that foreign buyers no longer want at current yields. This is how pressure point 2 manifests. Not through dramatic announcements, but through auction mechanics that only bond traders watch closely. Payment rail experiments are accelerating. The Enbridge platform, a cross-border payment system involving central banks from China, Thailand, the UAE, and Saudi Arabia, successfully piloted $22 billion in transactions in 2025. This isn't a replacement for SWIFT. It's a bypass that works for specific transaction types between specific partners. A Thai importer buying Chinese electronics can now settle in digital yuan or baht, clearing through mBridge in seconds, with lower fees and no dollar intermediation. Each successful pilot proves the concept, attracts more participants, and reduces dependence on dollar clearing. The network effect works in reverse. Every participant that joins makes the system more useful, which attracts more participants. Central bank gold accumulation hit 1,000 metric tons for the third consecutive year. China, Russia, India, Turkey, and Poland are the largest buyers. Why? Because gold is no one's liability. It can't be printed, sanctioned, or frozen. When central banks diversify away from dollar reserves into gold, they're explicitly reducing exposure to U.S. monetary policy decisions. That's a vote of no confidence expressed through balance sheets, not words, and it's accelerating. Now, the invisible mechanism most people miss. Import price sensitivity is rising. The dollar index has been relatively stable, but import prices are climbing faster than the index would predict. Why? Because exporters are pricing in currency risk, future debasement, and reduced dollar demand. They're front-running pressure point 3. A German machinery manufacturer selling equipment to the U.S. sees dollar reserves declining globally and raises dollar-denominated prices by 8%, even though the euro only appreciated 3%. That extra 5% is a hedge against future dollar weakness. Your grocery bill reflects this before the official CPI data catches up. Import prices lead consumer prices by 6 to 9 months. What you're feeling now at the checkout is the result of decisions made by exporters last spring. Capital rotation into real assets is measurable. Commodity indices are outperforming equities on a risk-adjusted basis. Farmland prices have risen 40% since 2020. Industrial metals are showing sustained demand despite weak economic indicators. Wealth is moving into things that hold value independent of any government's printing press. This is what happens when credibility erodes, not when it collapses. The smart money doesn't wait for the crisis. It repositions during pressure point 2 and 3 before the transition becomes obvious. So what breaks first when pressure point 3 accelerates into pressure point 4? The mechanism is straightforward but devastating. The Federal Reserve faces fiscal dominance. The U.S. national debt is $38 trillion. Interest payments exceed $1 trillion annually. If the Fed raises rates to defend the dollar's value, the interest cost becomes unpayable without massive spending cuts that are politically impossible. Every 1% rate increase adds $380 billion to annual interest costs. Raise rates to 7%, and you're paying $2.6 trillion per year just in interest. That's more than half the federal budget. If the Fed keeps rates low to service the debt, import costs surge and domestic inflation accelerates because the dollar is losing value against real goods. Inflation hits 8%, then 10%, then higher. Wages don't keep pace. The middle class gets crushed. There's no policy mix that solves both problems simultaneously. That's the trap. That's the constraint that forces the choice. History shows governments always choose the same option. Inflate the debt away rather than default explicitly. Why? Because default is immediate political suicide. Inflation lets you pretend it's not your fault. You can blame corporations, speculators, foreign adversaries, anything except the actual cause. That means your dollars don't vanish. They buy less. First through imported goods, energy, electronics, manufactured items, then through domestic services as the inflation spreads through the economy. Here's the mechanism that destroys the middle class. Wages lag behind prices because labor has less bargaining power than capital. Your salary might increase 4%, while your cost of living increases 7%. That 3% gap compounds every year. A family earning $75,000 with $150,000 in savings sees their real purchasing power decline. Not because the number in the bank account changed, but because that $150,000 now buys what $130,000 bought 2 years ago. Then $115,000. Then $100,000. Meanwhile, someone with $2 million in farmland, commodities, and productive businesses sees their wealth increase in nominal terms while maintaining purchasing power in real terms. The asset prices rise with inflation. The gap between those who own currency and those who own capital widens dramatically. This isn't a political statement. This is just incentives and constraints. A government with $38 trillion in debt and $1 trillion in annual interest does not have the option to preserve purchasing power. The math doesn't allow it. Pressure point 5 brings policy constraints that trap wealth inside the system. Capital controls become necessary to slow the outflow, not immediately, not dramatically, but gradually. Higher taxes on foreign asset purchases, reporting requirements for international transfers, restrictions on currency conversion above certain thresholds. These aren't announced as capital controls. They're framed as anti-money laundering measures, tax fairness provisions, national security protections. But the effect is identical. Money becomes harder to move out. By the time the average person realizes they should diversify internationally, the regulations make it expensive, complicated, and heavily scrutinized. 5 signals that tell you which pressure point is activating. Treasury auction results. Watch bid-to-cover ratios and foreign participation percentages. Declining numbers mean pressure point 2 is deepening. If bid-to-cover drops below 2.0, that's a red flag. If foreign participation falls below 20%, that's crisis territory. Import price indices relative to the dollar index. If imports are rising faster than currency weakness would predict, that's pressure point 3 front-running. The Bureau of Labor Statistics publishes this monthly. Compare import price inflation to the dollar index movement. The gap tells you how much exporters are hedging against future dollar weakness. Cross-border payment system adoption rates. More countries joining MBridge or bilateral settlement agreements means dollar bypass is proving viable. Watch for announcements of new participants, especially if they're energy exporters or major economies. Central bank reserve composition reports. Declining dollar share and rising gold holdings signal intentional diversification. The IMF publishes COFR data quarterly. Track the trend, not individual quarters. A sustained decline over 12-18 months is the signal. Real asset price movements relative to paper assets. Commodities, farmland, and productive businesses outperforming bonds and cash means credibility is eroding. When farmland delivers better risk-adjusted returns than Treasury bonds, the market is telling you something about long-term currency expectations. This isn't about timing the collapse. It's about recognizing the transition while you still have options. The 90-day scenario isn't a prediction. It's a framework for understanding what activates when a parallel system launches. Whether it happens in March 2026, June 2027, or never in this exact form, the pressure points remain the same. Next episode, we break down which assets historically survive when a system is bypassed rather than crashed, what preserves wealth when the anchor currency loses its exclusive privilege, and what collapses first when pressure point 4 fully activates. The pattern is absolute. The sequence is documented. The only variable is whether you see it before the adjustment or after you've already paid the price.